Welcome back to another episode of the Pursuit of Progress podcast. So today we're diving into a topic that affects millions of Americans, the dangers of student loan debt. Whether you're thinking about going to college or maybe you're already just grappling with student loans, understanding these dangers can really help you make better financial decisions and avoid student loan regret. Now, let's go ahead and get started. Ben, my trusty sidekick, my co-host, how are you doing today, bud?
Hey, I'm doing great and so excited to talk about this. It's a little bit controversial, student loan debt, going to college. There's a lot of people that have come around and understand what the concerns are, but there are a lot of people in America, especially young people, that don't understand this. And so it's so important. Can't wait to get into the material and the content today.
Awesome, buddy. And just for our viewers, our listeners, we got a special episode today. We are actually at episode number 50. So a little bit of a benchmark for both of us today to celebrate. So with that, we've prepared an extra special episode, something that I know Ben is very passionate about and has a lot of value to provide you guys with on this subject.
What did you say is the average number of podcasts, number of episodes that a podcast has?
I don't know that specifically, but we have a friend of ours, Jay Metzger, who's out in California, and he sent us a text a while back when we first were getting started saying something like, I think less than, and again, guys, I don't know the exact statistic, but it was like less than 5% of podcasts make it past 25 episodes.
Well, here we are, double that.
10x, baby.
We got to be in the 1% then, if that's the case.
Yep. And quick shameless plug, you guys, before we get started, if you have any other friends, just people that you might be just interacting with, talking about, strategies to pursue progress and get better 1% every single day, make sure you guys are sharing the show. That's the best compliment you can give us. The best way to support us is just by sharing the show with a friend. So please do so.
Yeah, please do so. And especially today, because this is an important topic. Did you know that the total student loan debt in America in 2024 is over $1.7 trillion. That's more than all credit cards and auto loans combined. This is something where the problem is just getting bigger and bigger and bigger, and it's affecting young people more and more and more. And so today we have 8 important topics that are all focused around the dangers of student loan debt. You ready for me to jump in?
Yeah, Ben, that's a great little intro there. That is, first of all, that's crazy. I didn't realize that statistic. So that was pretty just mind-blowing to think. Say that again. So 1.7 trillion?
That's right. $1.7 trillion outstanding student loan debt in the United States in 2024. More than all credit card and auto loan debt combined.
That part is, I'm surprised by that. That's nuts. Well, yeah, let's go ahead and jump right in. Give us a little background on what your first point is today.
Yeah, and so just a really brief background on why we're creating this episode. I'm a mortgage banker, and I see this every day when I work with customers that are looking to get pre-qualified for a mortgage in a home. A lot of young people that I work with do have student loan debt, and most of the time they don't understand how it works, what the pitfalls are. Even after college, they don't understand, and sometimes they'll notice their student loan balance is getting bigger than where it initially started 10 or 15 years ago. So we're going to cover a lot of that today. But here's point number 1, minimal education and consumer advocacy surrounding student loans. One of the biggest dangers of student loan debt is the lack of education and consumer advocacy surrounding how student loan debt works. No one is representing the student. You have all of these universities that are representing their interests. You have these financial institutions that are representing theirs, but no one is actually representing the student and really educating them on how student loan debt works. There was a recent survey by the National Endowment for Financial Education that found that only 17% of students feel confident about their financial knowledge when it came to student loans. And so what happens is you have students that are going to college, enrolling in student loans, taking debts, and a lot of times it's a very high number of debts, and they're not educated on what they're doing. So when you're not educated, it can lead to poor financial decisions, poor borrowing decisions, And what ends up happening a lot of the times is you have students that actually end up taking out more debt than they can either handle or that they're going to be able to pay back. So very, very concerning. And as I mentioned a minute ago, a lot of these universities, they just don't provide the guidance or the adequate resources to help students make informed decisions surrounding, number one, what their options are. Because you can go to college without taking student loans. There are other ways to do that. A lot of these universities don't do a good job of explaining what the students' options are. And they also don't really communicate how, what are the features of the student loans? What are what is it going to look like 5 years from now, 10 years from now? What do the repayment terms look like? They do a very poor job of explaining that.
So I think of a typical, freshman or somebody that's going into college, just finished high school. They're 17 years old, probably either don't have a credit card, or if they do, they have very limited credit history. How do these lenders at the universities qualify or disqualify a student from getting a student loan? Like, how do they gauge their credit score, so to speak? What's the level of confidence they have? Is there still usually typically like a ceiling that they'll provide a student loan for, and anything above that has to be co-signed by the student's parents? Or, because I know, just on a side note too, before you answer that question, student loans are one of the only non-forgivable loans, correct? It's just basically taxes and student loans. Is there anything else?
Yeah, that's one of the topics that we're going to talk on later.
Okay, cool.
The fact that they're not dischargeable in bankruptcy. But to answer your question there, the analogy that I always like to use is go back to the housing crash of 2008. Why did that happen? And the reason that happened is because credit or mortgage at the time was so easy for anyone to get approved. It was so accessible. There were literally programs out there where if you didn't have a job, well, let's just say that you have a job. Your income's not high enough to qualify for this mortgage. Well, let's triple your income from, you make $5,000 a month and you can't qualify. Let's say that you make $15,000 a month. Your credit is 550. It's terrible. Well, what we're going to do is we're just not going to pull credit then. And we're just going to, there were literally loan programs out there back in 2008. And so when credit became so accessible, it's referred to now as the ability to repay. You had borrowers that were getting into loans that literally did not have the financial capacity or the ability to repay. So what happened after 2008 is there was government reform. And what's very different in the mortgage world compared to 2008 is now, whether it's an FHA loan, conventional, borrowers have to demonstrate that they actually have the financial means to pay back the loan, or they have the ability to repay the loan. So the answer to your question is, in the student loan world, which is point number 2, there is not a bona fide requirement or document. You don't have to document the ability to repay with a student loan. So, what we're talking about is, unlike a traditional loan for a car or a home, you have to pull credit, you have to provide financials. A lot of times there's a employment verification. In the student loan world, it's very, very different. You can get approved for student loans with very little oversight, and it's just very, very accessible. So if you're a student and you're interested in going to college, you're going to be able to get approved for a student loan. That's exciting in the aspect that there's potential opportunity, but it's frightening because you have these students that literally don't know what they're doing. They don't know how any of this works. And they're taking on tens of thousands, in some cases, hundreds of thousands of dollars in student loan debt, and they have no idea what they're signing up for.
And at that age, you're so emotionally vulnerable, or you can easily be kind of swayed as far as, all your friends are going to college. You really want to go, but, just maybe it doesn't make sense financially. Instead of, making a smart financial decision, you're going to lead with your emotions at that age, not having that kind of reflex built up over time of just knowing when to pull back and when to actually spend money. And in a lot of cases, yeah, like you're saying, they're just putting themselves in situations that they can't get out of at a very young age, where, I think for a lot of people, yeah, if they go into a university for a degree that's not even what they end up wanting to do in their life, there's just a lot of big repercussions from that one moment in time.
Yeah,
Gary.
it's outrageous. I mean, we are asking, this is how I think of it. We're asking teenagers to make a decision that is literally going to impact them potentially for the rest of their life. Is that fair?
Crazy.
Is that fair? That's terrible. So, and to your point, what are teenagers going to do? Are they going to want to do the smart thing, the responsible thing, or are they going to want to go do what all their friends are doing and keep up with the crowd? You're exactly right.
So just for my personal just insight here, the student gets accepted to, a very high level private university that's $30,000 a year. There aren't very many disqualifiers. It doesn't sound like. I mean, if you're at that young age, you don't have much credit history or any history in general, just to show your ability to repay, other than just knowing that this is an unforgivable loan and you're on the hook no matter what. I mean, how are the lenders able to kind of vet different, are they basing it off of the quality of the university and the expected income that student's going to be making once they hopefully graduate from university?
Well, if you think about it like this, when we're talking about car loans, when we're talking about mortgages, there's collateral, right?
Exactly. Yeah, exactly. There's no collateral with the student loan. What's the collateral?
Well, there is. And this is the part that's scary. The individual is the collateral. And so because these loans aren't dischargeable, you can't, there's no way to file them or include them in bankruptcy. There's no, politicians talk about student loan forgiveness, and I hope that happens at some point. But the reality is that hasn't happened yet. The student is the collateral. And so the actual individual person. So that debt, once you take it out, and that's why these lenders are so eager to enroll these students in debt, because they have very little risk. A student can stop making payments, but there's also no statute of limitations on student loans as well. These other types of debt, credit cards, auto loans, there is a statute of limitations on. So if you're a student, you take out $100,000 of student loan debt, number one, you are the collateral. And number two, there's no statute of limitations on that. So if you take out that debt when you're 20 years old, well, when you're 50, you're still going to be getting collection calls.
Wow. And I'm pretty sure you're going to cover this a little bit later. So if so, we can hold on this part of my question. But there's also a huge commonality of students only paying the very, very bare minimum, which is basically just the interest, where, these loans are never paid off early, or, it's very rare to see these loans, paid off at a reasonable time, just because they're just always paying that minimum and really never even getting down lower in the principal.
That's exactly right. And there's two different features of that. There's forbearance, and then there's the income-based repayment. And we are going to go over both of those here in a little bit,
Okay.
so I'll hold that for a little bit later.
Okay, cool. Well, let's jump into, are you ready for point number 3?
Point number 3, yes. Point number 3 is over-reliance on loans due to rising tuition costs. Now, I have a quote here from Nelson Mandela. He said that education is the most powerful weapon which you can use to change the world. And I believe that. What Nelson may not have realized, though, and this is kind of a joke, is that tuition costs have skyrocketed over the past few decades, making it almost impossible for students to afford college without taking out significant loans. So to kind of give you an idea, student loans, and this report is from the College Board, has reported that tuition has increased by over 200% since the 90s. And because of that, and I also use that 2008 housing crash again. So what happened in 2008 with the housing market? There were two things. Credit was very accessible, so anyone could get a mortgage. But then what did that do to home values? Well, home values shot up rapidly, didn't they?
Mm-hmm.
And the reason for that is because credit was so accessible. So anyone could go get a mortgage. Anyone could go buy a home. So the value of the asset, the homes, skyrocketed, and it then created a crash. Well, what's happening in the student loan world? Credit now is very, very accessible. Anyone can get a student loan. What's happened to the cost of education? The cost of education has consequently skyrocketed. And that's these problems are feeding themselves. And so it's this over-reliance that creates a dangerous cycle where students become dependent on debt to pursue their education, which then leads to overall higher debt loads.
What is the kind of average percentage interest rate for student loans? Is it
Yeah,
5%,
it can
10%?
vary, and some of that depends on whether it's a private or a federally backed student loan. Usually, the interest rates are, they're not terrible. I would say on average 4 to 10% range. Interest rates in general over the last couple of years have been lower. They're obviously higher now than what they've been, but the interest rates are not terrible. What is terrible is the repayment characteristics and the features of how student loans actually work.
Another just kind of a random question that popped into my head, but do you think I know we always use the word student loan, but there's still a lot of families that the family, the husband, the wife, collectively, the two of them, they're the ones that still want to pay for their children's education, but they just don't have the financial resources to pay out of pocket. So they're the ones that need the loan. Is that still considered a student loan if it's the parents signing on the dotted line and they're, responsible, but it's for their son or daughter as the student? Or is that just a totally separate, like, bank loan? Is it still considered a student loan in that case?
Yeah, most of the time, the primary applicant is always going to be the actual student. In some cases, there are options to have a parent or a loved one co-sign. Now, I would caution against that for a parent, because then at that point, you are now on the hook with this same toxic debt.
Mm-hmm.
So really, thinking about co-signing is something that you really want to be careful about, especially with this type of debt. I'm okay with parents co-signing if it's the right type of debt. For example, if it's a cash producing asset that's going to appreciate over time, like real estate, I'm very in favor of a parent co-signing for a child on that. But when you're talking about depreciating assets, auto loans, like, a parent, in my opinion, should not be co-signing for their child's auto loan, because all they're doing is teaching them to stay poor. If they can't afford the loan, it's because they literally can't afford it, or they have a documented pattern of behavior of not paying their bills on time. And and then when you factor in the fact that it's a depreciating asset that it's going to go down in value, it's just not a healthy thing. Student loans are a little different. The biggest thing about student loans in 2024 is you have to have a plan. You have to know what the return on investment is. Back when we went to school, we still went to school, 20, 25 years ago, where you could just go get a degree. It didn't really even matter what you majored in. You knew it was going to pay off.
Mm-hmm.
Well, that's not the case anymore, because, there's two reasons for that. Number one, the cost of education has gone up so much. And then number two is the labor market.
Mm-hmm.
A lot of these degrees aren't in demand. And we're also going to chat on this a little bit later, but employers are now really starting to focus on skills more than actual degrees. So how skilled are you at the specific job you're looking at versus what degree, what is your degree in?
Which I am 1000% behind. I should always be about skills and not about just what a piece of paper says. I mean, there's certain degrees and certain industries, occupations where if you're a doctor, an engineer, certain things, obviously you need to have that. But I still think, though, the merit of your performance and your skill set is so much more important than just a piece of paper.
I agree 100%. And I'm so glad that's finally happening and things are changing with that regard. But there are a lot of younger folks and people out there that are reluctant because now they have this degree that they spent, 6 figures on, and they think that they're entitled to go get this job. So things are changing. We're in the digital age now. Things are changing.
Before we move on to point number 4, I'd like just for you also to share. I noticed that you have in our notes about a resource for financial aid and some of this just rising costs that people are faced right now with student loans. What's that about?
Yeah, one thing that's really, really important is students need to consider what other possible options there are before looking at student loans. And so there's a resource that is the scholarship handbook by Edward B. Davis. And what this does is it helps students navigate what other possible financial aid opportunities there are, what other grants, scholarships. It puts them in it gives them resources on how to find that information out, how to make phone calls, how to research it. So that is my suggestion when you are a student, and if you're considering, number one, higher education, and then if you're also considering student loans, you want to make sure you are well informed as far as what other options are out there. Do I have to go the student loan route? Or maybe I can get a grant or a partial scholarship And instead of having to take a $50,000 student loan, I only need $15,000. So it's a great resource just to help navigate options.
Got it. Okay, cool. Let's talk about point number 4. This is going back to my question earlier about that income-based repayment. So just to kind of touch again on what you were sharing earlier, there's only a couple types of loans that have no forgiveness clause. There's no way to get out of it. Once you've signed on the dotted line, you're going to pay that back one way or another. So student loans are an example of that. So what is the income-based repayment?
And yeah, so this is point number 4, income-based repayment, and how these universities and student loan servicers pitch this to students and folks that are, recent graduates and entering the workforce. They pitch this as a positive thing. And the reality is this is a huge, huge red flag. So this is how it works. When you graduate, you're required to disclose what your job is and how much you make, and then your student loan is going to enter repayment. Well, there's an option called the income-based repayment, where if you're making a certain dollar amount, if you can't actually afford the fully amortized payment of the student loan, you have the option to do an income-based repayment. So, for example, let's say that your student loan balance is $60,000. And your normal fully amortizing principal and interest payment would be $500 a month. But because you're only earning $40,000 a year, you submit an application to qualify and you get approved for an income-based repayment of only $150. So your payment's supposed to be $500, but you get approved for an income-based repayment of $150. That sounds awesome, doesn't it? Your payment's only $150 instead of $500. Who wouldn't want that? But this is the part that's not explained. So when you look at that right there, there's a difference of $350 a month. Well, what happens to that $350 a month in interest that's not being paid? Well, that gets added back onto the loan every single month. So if you started with $60,000 after month 1 of being on an income-based repayment, now it's $60,000 plus $350. And then every month you do that, you add another $350 on. And here's the really scary part. That $350 that you add on every month starts accumulating interest. So it literally reverse compounds. A lot of us know how powerful compounding is when it comes to investing over time and consistent. This is the same thing, except it's the opposite. And in the banking world, when I'm qualifying customers for mortgages, I always share this story. This was a gal who was a first-time home buyer at age 48, and she had her student loan debt for nearly 30 years. So, she got it when she was a teenager. Her student loan debt started off at $40,000, and by the time she bought her first house, almost 30 years later, in the late 40s, it was approaching $200,000. Started off at $40,000. And now it was over $200,000. You can't recover from that.
No. And when you're adding that additional, that $350 example every single month with an income-based repayment plan, that's not they're not changing or allowing you to extend the amortization timeline. It's still whatever for example, if it's a 30-year loan. Is that typical? Is it 30 years, typical, like a home loan? Is it?
Yeah,
for
student loans are usually longer term, usually around 20 years is what the normal amortization is. But then kind of based on your situation, that's where these payments can become flexible. And then that's where it gets so toxic. So you're already taking something that has a long amortization. And if you can't afford that, and then you're manipulating that to make it more affordable in a monthly cash flow, it's a really dangerous spot to be in.
But they're not extending the amortization. If it's due, January 1, 2050, you're not able to, every month when you're only paying that minimum, it's not, what I'm getting at is it's not changing or extending that deadline. So it's almost like a balloon payment where you get towards the end there. And like you're saying, instead of a $40,000 loan, all of a sudden, not only do you have to pay that $40,000 that you've been putting off, it's now accumulated up to $200,000. That's crazy, man.
What's happening is, you're never actually touching any of the principal. And so on these income-based repayments, you're not even paying the full interest. And so if you're not even paying the full interest, what would normally be a 20-year term can extend into 30, 40, 50 years or more.
And then one last question before we go into our break. What happens if you're just not able to pay the loan? Like, let's just say that example of, the term of your loan ends, you owe $100,000. I mean, it's just similar to not paying your taxes, I guess. The government puts a lien on any other things that you own, and you kind of go down that same path as you would not paying your taxes.
You can try changing your phone number. You can try changing your email address. These collectors will find you. When it comes to government loans, so FHA or VA loans, we are all banks are always required to submit a CAVRS report. And what that is, that's where the bank contacts the government to see if that individual is delinquent on any type of government debt. So if they're delinquent on any type of government housing debt or IRS debt or student loan debt, and if they are, well, it's going to make them ineligible for any type of government financing until that debt has been resolved. So if you stop making your student loan payment, it'll go to collections on your credit report, and it'll just stay there and never go away until it's dealt with.
That's crazy. Let's go ahead and take a quick break. I think we have a sponsor. Ben, you want to read that one?
Yes, we do. This is from our sponsors. They've been itching for us to get to the break here, so I'm glad that we did that. Looking for a real estate team that goes beyond closing deals? At Adam Sells Denver, they're here to guide buyers, sellers, and investors with strategies tailored just for you. Visit adamsellsdenver.com for free resources or call 970.
Thank you for our sponsors today. So let's just jump right now into point number 5. So this is similar to what we were just talking about as far as this repayment. So talking about how it's non-dischargeable in bankruptcy. So shed a little bit light on this one.
That's right. Point number 5, non-dischargeable in bankruptcy. Now, when you think of other types of debt, what happens if you stop paying your mortgage? The bank is going to foreclose on the loan, right? They're going to foreclose on the home. They're going to repossess the home, take the collateral. If you stop paying your auto loan, same thing. The vehicle is the collateral. Your vehicle is going to be repossessed. You have unsecured debt like credit cards. If you stop making payments there, your credit cards are going to get turned off. You're not going to lose anything. It's possible they could file a judgment and put a lien that's associated with your name, but you would have the option of putting that into bankruptcy. All of these other debts, if you get, most of the time, if you get into a spot where you're over leveraged, or if you have a financial hardship or a loss of income, you can file for bankruptcy. And a lot of times there's 2 different chapters of consumer bankruptcy debt. There's Chapter 7, which is liquidation, and there's Chapter 11, which is reorganization. Chapter 7 bankruptcy is where essentially all of your debt is forgiven. Chapter 11 is where you have to reorganize your debt, and then you make payment plans to the courts. Everything is paid off, and then you make payments directly to the courts, and the courts then pay forward those to your creditors. And most of the time, you end up not paying all of the debt back because it's a lesser amount. Well, when it comes to student loans, what we talked about earlier, you are the asset. The only way to get rid of a student loan is pay it off or die. And even if you die and you own other assets, it'll be attached to your estate. You can't get rid of student loans. There's nothing to foreclose on, and you can't include them in bankruptcy. So if you have some significant life event, if you get in a car accident, if you have a loss of income, if you can't work anymore, all of those other debts are bankruptcy eligible. Student loans, though, are not. And that feature alone makes it's one of the most toxic characteristics of student loan debt. There's literally no way to get rid of it other than pay it off or die or hope that the federal government will do some type of loan forgiveness. But even under the Biden plan, to qualify for the student loan forgiveness, there were multiple criteria that you had to meet to even qualify. And then I think it was like $10,000.
Yeah, $10,000.
So if you have $70,000 student loan debt, is $10,000 going to be life-changing? Is that going to, are you appreciative? Are you thankful for that? Yes. Is that going to really move the needle or change? No, it's not.
Yeah, I agree. I think I wasn't definitely not behind that one. It's just funny thinking about how credit cards can be if you rack up $40,000 of credit card debt, you don't have any collateral there either, for the most part. It's kind of similar to a student loan in that regard, yet you're able to take that to bankruptcy and wipe your hands clean and be done with it. I just don't understand just trying to think through the reasoning why student loans specifically are not forgivable. And I'm assuming it's because if they were forgivable, they'd have to have a lot more stringent criteria to qualify people. And that would be in a way, maybe, not treating everyone fairly or not giving everybody the same opportunity.
Yeah. It's opportunity based, but you have to remember that we're plugged into the matrix. Everyone is trying to take advantage of the American consumer here. So this is good for the government. It's good for the universities. It's good for the student loan servicers, but and it's disguised as being good for the individual because they are under the premise of everyone is having access to more opportunity. But if that opportunity costs exponentially more, and if that opportunity then has all of these toxic characteristics that surround it, and if you're not, if you don't understand what you're doing, is that really an opportunity? I recently read an article, and I think this is what you were hinting at, where it was about a student, a younger person. I don't think they were in their teenagers, but they were like early 20s. And he was very familiar with how student loans worked. And so he financed his education on a credit card. He was able to get credit cards with very high limits, and then he was able to pay for his education, his books, his classes on the credit card. Well, guess what? Credit cards are dischargeable in bankruptcy. Student loans aren't. I'm not saying go do that, but there are other ways there are other options out there.
Crazy. So let's jump into point number 6. Point number 6, mental health impact. Going through points 1 through 4, or 1, 2, 3, 4, and 5 so far, all of those have given me a little bit of anxiety, a little bit of mental uncertainty myself. So I can see how this is a very big, specific topic.
Yeah, and if anyone has ever been in debt, they're going to understand this. But myself, for example, when I was in my 20s, I made some really poor decisions. I had taken out these credit card advances to go start day trading in the stock market. And I maxed out all of my credit cards. I literally took out like $150,000 and started day trading with that. Does that sound like a smart idea? Does that sound responsible? I remember doing that, though, and the amount of stress and the impact that had on my mental health was just disastrous. I only did that for a month or two. I ended up taking some pretty significant losses, like $10 or $50. But the reason I did that, though, is because of my mental health. I literally could not function. And this is a survey by the American Psychological Association. It found that nearly 40% of student debt holders report experiencing severe anxiety related to their student loan finances. It's the constant worry about making the payments and the fear of default and what's going to happen after graduation that's impacting mental health. And when you are over leveraged, and if you have taken out too much debt, let me tell you, it's real.
Yeah, what comes to mind when I think about this scenario too is, well, two things. I was going to bring up this first one maybe after the last point, but just the concept of how many students start and don't finish, yet they still have this now huge, excessive amount of money to pay back for not really anything to show for it. But so that was kind of one thought that I had earlier, but also just about this mental health. Imagine being, 3 years into your 4-year degree and realizing that this is just not something you want to do anymore. You want to go into a different direction, yet you're like, well, crap, I need to just finish what I started just so I can pay off this debt. And then you're in some industry or some career path that's not serving you and not where you're meant to be.
That's exactly, I could not have said it better myself. That's exactly it. How frightening and scary does that sound? And when you're talking about teenagers having to make these decisions, the frequency with which those things happen is very, very high. It is not uncommon for a teenager or a young person to get 2 or 3 years into a degree and be like, you know what? I don't want to do this anymore. I don't even know if I want to graduate. But what do? I have $75,000 in student loan debt. I don't know what I want to do, but I know I don't want to do this. But now I have $75,000 in student loans. That's like what do I do? What is the answer? The other thing that I see a lot is people going back to get their master's, thinking that it's going to benefit them in the workplace. They're going to be able to earn more, but that just isn't always the case, right? Especially now. It almost seems like in some cases, having a master's is, it's like a lot of these companies, we're going to go find just the person that's really well skilled. We're not really, we don't care about your master's. And the cost of that master's, though, can be significant. But the value that it adds can be questionable depending on what it is.
Yeah, I remember in business school when we were, both at CU 20 plus years ago. I remember in a couple of the business classes, they talked about, I think it was in the Asian cultures where they don't really focus as much on master's degrees, I believe, but they focus more on, I think it's called Kaizen, where it's like vertical integration, where most people over in Asia work for only one or two companies their entire career. They're very loyal to whatever company they start with. And they just very highly value this promote from within mentality where, again, you're not just skipping around trying to get a little bigger, better deal over here. And then, if I get $100,000 master's, then I'll be able to get even a bigger, better deal over here. Just really going back to just the simplicity of get a company that you really want to work for and it's going in the direction that you want to go, and just put your time in, add additional skills as you continue to grow with that company. And then because of that, get promoted and get whatever you're going to get if you went and got a master's.
Yeah, that was America in the 50s, 60s, 70s. It was not uncommon to see one person spend their entire career at said employer. Back then, though, individuals, what's happened over the years, when you think, for example, of just like healthcare for the individual consumer, is healthcare coverage and cost more favorable or less favorable for the individual now compared to 30 years ago? Less favorable, right?
Yep.
How many companies offer pensions now? None. No one offers a pension. There are a lot of companies out there. A lot of companies 20 years ago used to match dollar for dollar on a 401k contribution. There are a lot of companies now that don't match at all, or it's only a partial match. So what's happened, these employers, the benefits that the individual gets is so much less now than, really whatever it would have been. So it's up to the individual to really take their power back and put their future in their own hands. But this way of thinking, I have to go to school, I have to get a degree, that's a flawed way of thinking. It's not relevant in 2024. It can make sense, but you have to be intentional. You have to go to college now with a plan. You can't just be like, I'm going to go to college, I don't know what I'm going to do, I'm going to take out the student loan debt, and I'll figure it out in 2 or 3 years. That's a plan like you were just talking about for disaster.
Very well said. Let's jump into the next point.
Yeah, and I'll be brief on these last two because I know that our sponsors are trying to get us going here. So point number 7, limited life choices. And this is another really important one because when you have student loan debt, it can significantly limit your life choices. And it can force students or young people to delay major milestones like buying a home, starting a family, or pursuing their dream career or starting that new job. This is another study from the Federal Reserve found that over 40% of borrowers reported delaying important life decisions due to their student loan debt. And again, that's just another reason that I love my job. I always say my job as a mortgage banker is a window into the American economy because I get to see everyone, how they're behaving, how they feel about their finances. And I cannot tell you how many times student loan debt prevents someone or holds someone back from purchasing a home, either actually becoming a homeowner or buying the home that they really want. So this is real. It really can delay significant other life milestones.
And just one little quick side note on that one. So for anybody listening that is maybe dealing with student loans and also considering buying a house, you shared with me recently about how the dollar amount of the student loan, let's just say you have a $50,000 student loan, they're not really taking that $50,000 as part of your loan qualification for your home. They're trying to, they figure out what that monthly payment is. And then that's what explain that a little bit.
Yeah, so a lot of times when a young person or a recent college graduate is coming out of school, their loan is still in forbearance. So it's not uncommon for me to get a call saying, I have student loan debt. Don't worry though, because I don't have a payment yet. It's actually in forbearance. I'm not going to start making payments on it until 6 months from now or a year from now. Well, hold on a minute. It doesn't matter if you're making payments or not, because every type of loan, whether it's conventional, FHA, will have a specific way that that program calculates student loan debt, regardless if it's in repayment or not. And most of the time, it's going to usually vary from 0.5% up to a full percentage point per month. And so in that example, on a $50,000 student loan, even if you're not making payments on it, more than likely the lender is going to estimate the payment to be $250 to $500 a month, because they know that at some point you will start making payments on that. Now, student loans is one of those guidelines in the mortgage world that is just constantly changing. It seems like it changes every 3 months. So that's where it's at now. There have been some recent updates that have allowed for a little more flexibility than in the past. But the reality is that even if you're not making payments on it, that student loan, there still is a financial consideration, and it's still going to be factored into your qualifying.
Got it. Thanks. All right, well, let's wrap it up with point number 8, lack of financial literacy and deceptive tactics.
Yeah, and the reason I have this on there, this kind of goes in with that first point, but no one is representing the individual. And a lot of students aren't fully aware of what the true costs of their loans are, or what they're actually agreeing to. And as a matter of fact, the CFPB just found that over 45% of students did not understand their repayment options when they took out the loans. So imagine that. 50% of borrowers who are taking out student loans don't understand how they work. And I can promise you the other 50% that say they do not totally understand. They may understand some things, they do not fully understand. So for 50% to acknowledge they have no idea how the repayment works, who's advocating for the student? Who's advocating for the individual? There is no one that is actually looking out for the student. So that's always my number one thing. So if you are the student and you are considering student loans, make sure that you're asking lots of questions. Ask questions about the loan terms. How does the interest compound? What happens in the event of default? Is your student loan eligible for student loan forgiveness? You want to go in with as many questions as possible up front, so you understand exactly what you're getting into, and so you can make an informed financial decision on if this is something that you want to pursue or look at other options.
You think of the government having this be such a hot topic and important, thing that they need to improve upon, why they don't, look into, maybe they do, having some sort of a requirement that there's guidance counselors. I know that's part of what the current counselors at schools do, but almost like you think of like health insurance, so there's all these like third kind of like intermediary type people that are kind of educating, showing what options are out there. It just seems like, if nothing else, just having a budget through the government to help pay for some sort of a role that is for this purpose, just financial literacy and just explaining thoroughly to anybody before they sign on the dotted line.
Yeah, there's no one representing the borrower. And every election cycle, what's one of the main topics that I didn't feel like there was as much of this last election cycle, but student loan forgiveness, right? Everyone is always talking about student loan forgiveness. That literally does nothing to address any of the core problems with student loans. If someone gets their student loan forgiven, I'm happy for you, congratulations, but that does nothing to solve the actual problem.
Faucet is still on. Yeah.
The faucet is at full blast. And to answer your question, the reason that there hasn't been any reform yet is because it would be viewed as opportunity restrictive, meaning that students are not getting the same opportunity. Because, can you imagine if students had to go through the same qualifying process to actually qualify for a student loan? Well, it would be much more difficult. You'd have to have proof of income. You'd have to be able to document credit. It would be much more difficult to qualify for. But then what if you could get rid of it in bankruptcy, or it could go into foreclosure? It's something that needs to be considered. There's a better way And this is my other thing, because it's so easy to get qualified for a student loan. That's a big part of the reason with the cost of tuition going up so much. So the best way to fix tuition going up is making credit less accessible. And when that happened in 2008, there was a crash in the housing market, but values corrected themselves. And if that happens in the student loan market, tuition will then self-correct as well. I don't know if it's going to happen.
I wonder if this will just kind of not correct itself, but improve a little bit just on the popularity of going to college. I just got to think that that has gone down a little bit, just again with the type of job opportunities that are out there today, but also just with COVID and all the other just kind of changes that happened over the last few years. Yeah, I just wonder what percentage of students today are pursuing college versus 5 years ago, if that's gone up or down.
Yeah, I would say that our generation was the last generation that got a really bona fide return on investment from a college degree. And so the generations after us from 2010 and after, they're in a different world. And they're in a world where return on investment is not guaranteed. It's questionable, where student loan, the cost of education is exponentially higher. They're getting paid less to do the same job. When you factor in all of these other increases in housing and affordability across the board, it's a completely different world for young people today than what we grew up in. So what I'm trying the reason I'm so passionate about this is because there's just that old adage that you need to go get a degree. It's the only way to be successful. And that's just not true anymore.
Yeah, hopefully that continues to be more and more understood by everybody, because I agree. There's no shame or embarrassment to be a plumber, an electrician. In fact, I think those industries or those professions are going to only continue to have a higher dollar per hour over the next few years, while a lot of these others are going to either not exist anymore or significantly decline.
It's funny that you mentioned that. Like when I think of thriving industries, I think of construction, I think of plumbing, I think of HVAC, the labor, the skilled labor. Those industries are thriving.
Yep, agreed. Well, I think we got a lot of value out of this one today. I know I did, just learning a little bit more about some of these just scary aspects to student loans. You guys, just want to first of all just thank you again for making it through 50 episodes with us on the Pursuit of Progress podcast. Today, we really unpacked the dangers of student loan debt, from that lack of financial education to just the overwhelming mental health impacts, and just really how these loans can limit your life choices. So just remember, whether you're considering college or you're just currently managing your loans, understanding the risks and exploring alternatives like scholarships and grants can really make a world of difference. Knowledge is power, so advocate for yourself and just make sure you're making informed decisions. Ben?
All right. Well, we love everyone. Thank you for tuning in. Be sure to give us a shout out on social media. If you have any questions, drop that in the comments. And until next week, this is Benjamin Adams for Adam Lang on the Pursuit of Progress podcast. See you guys later.